fruitful thing for people. And so it's really, I'm excited today, Stephen, to have you here with us to talk about how you can go down the path of financing and acquiring Airbnbs. But everyone on the call, I really want to make this distinction here, because the first time I talked to Stephen, I made this mistake. I thought that when I was talking with Stephen the first time, it was about acquiring property that was already currently an Airbnb. And that's not it at all. Stephen and his team over at Excelerate have a process, have a methodology, have a plan for you to purchase property that is not currently operating as an Airbnb and use potential Airbnb income to help you actually qualify for that house. Yes, I know this feels like the Holy Grail. Stephen's going to share with us that. And so, Stephen, welcome to the show, man. Say hello.
Hello. Thanks for having me. I appreciate everybody being here, and I'm excited to talk about how we accomplished the task which Ian so carefully positioned. You know, I've been in lending for about 20 years, and we've seen a lot of investment properties come and go. But the reality is when you as realtors do what you do with looking at the market and trying to find comps and recently listed properties, you're achieving a price point for your customers, your buyers and sellers based on existing data. And this data exists through Airbnb and VRBO and these short-term rental platforms. They are tech companies. So when somebody rents a room and rents an Airbnb and pays that fee, that information is being collected by Airbnb and VRBO and these companies. And as we all know, with this day and age, data is valuable. And so we have a third-party vendor called AirDNA, which we contract with, that allows us to put in an address, and it gives them a report back that's the same information that you would get if it was a recently listed or recently sold homes, except this is 5 comps of Airbnb or VRBO or similar properties within close proximity to our subject. And from that information, and that's actual hard data, it's not an estimate. What they can do is they take that hard data and they come up with an expected amount of income over the next 12 months for our subject property. And thus we can, as a lender, use that information as income in which to qualify a loan to then buy that property. So do you have the slides?
Yeah, I've got the slides. I was going to say that's really crazy. Is the help, I guess, for the folks on the call to decipher between, is this a specific product for like Airbnbs, or are you guys like piggybacking off of another type of like loan product?
So we have a couple different ways that we finance investment properties. The most popular right now and the most effective is something called a DSCR loan, which stands for debt service coverage ratio. And basically, it's a similar approach to how commercial properties or even private money loans are qualified and financed, where we are only using the income from the property to support the loan. And so you have, just in real simple broad strokes, you have a property that makes $3,000 a month in rental income. Well, the ideal is that you have a payment on the property that's about $3,000. And in that example, you would have a 1-to-1 ratio. We don't use any other information about the borrower and their income to qualify the loan. It's purely as if the property was the borrower, and the property is generating the income that's used to support this loan and make the payments. It's coming from rent. So that's the specific product. It's not a Airbnb or short-term rental specific program. It's a feature of our DSCR program. We have several different investors that we work with, and so there's different criteria depending on your borrower and your scenario that we go against. But yeah, it's a feature. It's something that honestly is not that new, but not as many people understand how to apply it and actually have used it. So it's something that I chose to dig into and bring to market to show you guys.
Awesome. And thankful that you did that so that we could have this call today. But more importantly, let's jump into your slides here. And I've got AirDNA pulled up on another screen. So Stephen, if you want to pop over to that at some point, we can share that
Sure.
too. So, but I'll let you drive.
Click forward. to the next one. And I'll jump through this. This kind of stuff is very basic. We're based in Irvine, California. We are a national company in all but 3 states. One of the leaders in a section of the mortgage business called non-QM, which for all intents and purposes just means alternative documentation, alternative ways to get loans qualified and closed outside of Fannie, Freddie, and government loans. Next slide, please. So really quickly, I think, Ian, you're going to make this available or post this online. So I won't necessarily spend too much time on these, but these are some of our programs and niches. Again, we are everything but the regular vanilla loans. So we do bank statement qualification. There's our DSCR program. I can go multifamily up to 10 units. We have some mixed use appetite. We have a profit and loss only program where self-employed borrowers can qualify off a profit and loss from a CPA, ITIN loans, standalone seconds. We do really big loans. I'll let you read through the rest of these. The focus today is not on our niches, just kind of giving you a preview. We do a lot of different things. The real value comes from working with me. I've been doing this a long time. And so understanding and structuring loans is my bread and butter, and knowing my programs and how to take your borrower and get them qualified with someone like Ian Lee, who is an expert in your area. And we have a close working relationship, and he can bring loans to me that I can help him structure, we can get closed. Go to the next slide, please. So DSCR, again, debt service coverage ratio. Next slide. Okay, so kind of an overview of this program. So we don't use borrower income. In fact, my loan application, the IRLA, formerly AKA the 1003, doesn't have any employment or income on it. We do go as little as 15% as your down payment. There's a few strings attached that's a little bit easier to talk about when you actually have a scenario. The properties don't have to be occupied. So you can buy a vacant property and use this ability to look at either long-term rents based on a 1007, which is part of the appraisal, or we can use the AirDNA method that we're going to talk more about. The AirDNA, by the way, again, that's a vendor that we contract with. We pay for those reports, but this is the data that we can use to qualify. So I can pull it for any properties that you like and tell you what that information is. If it's something you want to use as part of a listing to get your product out there more. We can do it for first-time investors. We have a way of presenting this to our servicer so that you can have a DSCR loan that's funded, but it does not show in the borrower's credit report. And the reason why we can do that is because these are called business purpose loans. So they are used for people for business purposes. And when you vest the title in an LLC, we don't have to give the servicer the social security number and borrower's name. We can just use the LLC information. And so while the borrower is still signing a personal guarantee, which means they're on the hook for the loan, it doesn't actually have to appear on a credit report. And I'm betting that some of you know investors who have huge numbers of investment properties. So maybe they have 20 properties and they have to look for options for that loan not to appear on their credit report because Fannie, Freddie have certain limits to how many can appear there. And so this is a workaround. It's really, really fast. Debt service coverage ratio loans are among the fastest loans for us to close, primarily because there's less documentation that's used for these files. We're just basically getting our assets, an appraisal, a credit report, and an application. And that's typically what we're using for the loan, and of course, title and escrow and things like that. There's no reserve requirements under 70 LTV. We go really, really big, up to 3.5 million. And we also have this feature called no ratio. I hesitate to say this because it's a dirty word in our business, but stated income loans, for those who were around before the meltdown, they were owner-occupied loans that didn't require income documentation. That is not what this is, but I'm using that as an example to position that the debt service coverage ratio loan is in effect kind of like a stated income loan for an investment property. And that being said, you can have a loan, you can have a purchase or a refi where the payment on the property is actually more than the property can generate on rent. and you would have a negative ratio situation where you would be cash negative. And we can do those. So that is a huge advantage to this program, because you don't actually have to cover the payment. And then, of course, we look at the borrower's credit score and their assets. And also foreign nationals, we can do that using this DSCR program too. Next slide.
Yeah, Stephen, I was gonna take a moment here because I posted up a reel on Instagram like a week or two ago about DSCRs, and just kind of just putting it out there like, hey, did you guys know that this even like exists? And I got like a wild amount of comments, people DMing me. Candidly speaking, a lot of them were real estate agents that just didn't even understand that this was like a thing. But I had some pretty poignant questions in there. And so I want to ask you them so you can just answer them out loud so that folks on the call could like do it. So the first one was, can a first-time investor get a DSCR loan?
Yes. There are some restrictions based on the rest of their profile, based on credit score. But yes, a first-time investor is okay with us. Minimum credit score is 680 versus a 620 for people who own actively in the last 3 years. And for us, a first-time investor is somebody that's had investment properties in the last 3 years. So it is possible to have someone who's owned properties, 7 or 8 years ago. We would still consider that a first-time investor because it's not recent enough.
Okay.
There's also first-time buyers. I didn't put that in this, but I actually have a transaction that's going to docs today, or actually just funded today, for a borrower that rents their primary and is purchasing as their first property an investment property using the DSCR program. So our DSCR program allows for first-time investors, and it allows for first-time home buyers. Now, you can't buy the house next door, because we don't want this program to be used to circumvent the requirements for borrowers to show income to, occupy a property as their primary. But if you have somebody that lives in has let's say they own a house in Denver and they want to buy a ski condotel right up in one of the ski mountains, well, that's a resort property. That would make sense. They're not going to move to that condotel as their primary. So in that case, we'd be able to do the loan.
Awesome. And then another question that I had a few times was in and around, does the property need to be currently leased in order for you guys to do the DSCR calculation?
No, the property does not have to be leased. It can be vacant. If you do have a renter that's in the property that's being purchased or refinanced, what it does mean is that I'm going to use the lease income to qualify. So on every investment property purchase, as part of the appraisal, we're going to get a market rent survey called the 1007. And that's the appraiser looking at properties nearby and estimating the long-term market rent. But if you have someone that lives in the property, and let's say it's a recent thing, maybe 2 months ago they leased the property, we'll be able to use the lease as long as we see some canceled rent deposits. Now, the thing about an occupied property is that I won't be able to use this AirDNA short-term rental option. So in fact, you're almost better off having a vacant property under the DSCR loan for your purchase, because that way we can use the AirDNA option to look at the short-term rental comps in the area and potentially have more income to use to qualify.
Oh, wow. Okay. Do you have any like specific examples, some cited reasons that would, or common reasons, I guess, that would make it like a property ineligible for like a DSCR loan? Like, here's the real thing I'm thinking about is like, we run into problems every once in a while, people trying to buy. You made that analogy of like someone lives in Denver, they want to buy this house up in the mountains, but like log homes as an example, for some weird reason.
Right. Log homes. See a lot of those because they're extremely difficult to find financing. And anytime
but they look so cool on Airbnb, Stephen. That's what I'm trying to like.
Yes, and I guess you should add to those listings log home for sale only for extremely well qualified borrowers that can qualify for certain types of financing. Those are hard for us to finance. Dome properties, even modular, manufactured, anything that's outside of the norm is very hard for lenders that are at least on the national level. You're stuck kind of going for regional type credit unions, things like that. You probably know some folks in your area that do those, but in the non-QM space, we are taking this debt and it's sold to our end investor. And so we work off of what their tolerance is. And unfortunately, they have no love for the log cabins. But to go back to your original question about like what would disqualify a property for being used. So with AirDNA, and that's again our third-party vendor that provides this data, we get their estimate for the annual income. We also get a market grade, and our requirements are that you have a B plus, a minimum score of B in order for us to use the AirDNA. There it is right there, right? So that market grade B, if you got a B minus, it's not going to work, and there isn't any rhyme or reason or way that we could change that. That's what the investors have said. We want a B or better. If it isn't a B, then I have to ask for an exception, and the exception adds to the rate. There's better ways for me to get that loan done through our DSCR program than using AirDNA. So we've talked about your deal, Ian, and how there's this goes back to the cash negative, no ratio option that we have.
Yeah. Awesome. Okay. Well, let me jump back then into the slides here. I skipped ahead like one or two. And,
sure. Let's go back to, there you go. One more, go back one more, right there. Okay. So I'm going to just take you guys through an actual real world example of when using AirDNA kind of saved the day with a DSCR purchase. So I was 2/3 of the way through a DSCR purchase for one of my loan officers at Draper Kramer, actually. And this was on the East Coast. The transaction kicked off with them telling me, hey, my borrower's buying this rental property. We think that the rental income that's going to be on this property is like $3,000 a month. There's about $3,000, $3,200. So we're estimating based on the market that we're going to have a market rent survey on our appraisal for about $3,200 a month. And so we get 3/4 of the way through, and we get the appraisal because, of course, it comes in, towards the end. And the appraiser gives a market rent, long-term market rent of only $2,400, which was a bomb going off because suddenly now the way we'd structure the loan, this property can't support the loan that we're asking for. So we were going to have to restructure the pricing and the rates and the costs and everything like that. So we stepped in. I did the AirDNA report. And the AirDNA report, and I pasted a picture here, $60,000 and $60,600 a year in expected annual revenue with a 78% occupancy rate. Now, when we use AirDNA, I'm allowed to use 80% of the annual revenue. So I did the math for us down there. You can see 60,600 times 80% divided by 12 months. The AirDNA method allowed me to have $4,040 in qualifying income. So just to show the two, you've got the long-term rent option, $2,400 a month, and the AirDNA method, I almost doubled the amount of income that I could use to qualify this property. So right here is a great example of how I have a vacant property, SFR, straight up house, good deal, but for whatever reason, the appraiser just decided that $2,400 is what they were going to assign for long-term rents, and it would have added about 3/8 to a half point to the rates. Instead, we pivoted, used the AirDNA report. I almost doubled my income. And now you can see kind of in the middle where I point out that the PITI was $3,195. I have 1.26 times my payment in rent, meaning I can make my payment of $3,195 and I've got a little bit left over. So that's great. DSCR, the ideal is that I can at least break even on a 1-to-1 ratio. In this case, AirDNA was able to get the deal done.
And this is great that you guys do this 80% of income. As someone who's been managing Airbnbs for quite some time, I've grown to the point where I have property managers do it for me instead because I just can't handle all of the messaging. And I pay about 20-ish% of my gross income every month towards the property management. So this is a true litmus test of the appropriate, the net earnings from the property to be able to facilitate the debt. So that's pretty cool. You guys do that.
Personally, I think it's to take that one step further. I come from business banking. I was at B of A for 7 years. And with looking at how business owners run businesses and when they're sold, you could have a business that's around for 20 years and you get a new owner in to run the business. The banks look at it as a brand new business because they don't know how that new captain's going to, captain the ship, right? And with these Airbnb, VRBO properties, you can have people who have zero experience that are listing these properties. And so from a lending perspective, that's a lot of risk. But I think the fact is, at this point, we've got enough market data for a long enough period of time to where they can reasonably assume that that 20% variation, which is why they use the 80%, that accounts for people who may be better or worse at handling their properties. So you get a little bit of wiggle room. That's most likely why they don't go off of 100% of the AirDNA report. And here's the thing, I just want to make this absolutely clear. You are not required to Airbnb your property when using this method to qualify. This is the potential. So think about that for a second. You could think, I'm going to put a long-term rental in this property, but this property has the potential to earn this money. There's nothing that says I have to use short-term rental income after I acquire it. That's up to you. It's just that we're able to extend the amount of the loan to the LTVs that we extend it to, because we know that theoretically you could always fall back on using short-term rental to meet the demands of that payment each month.
That's
Let's
awesome.
go to the next one.
Yeah, absolutely.
So this is more for the loan officers and all of us, but I know that some realtors straddle both worlds. I literally just copied and pasted the guidelines. You can see there's not a ton. It's pretty straightforward. So purchase transactions, we need a 12-month history. My occupancy rate must be 60. I need 5 comps in similar shapes and sizes. And the market grade has to be B. That's it. There's no add to the rate. There's no penalty for doing this. So this is a simple option, simple way to go. Any questions before we move forward?
Yeah. If anyone's got any questions, either come off of mute and ask it yourself or just pop something into the chat. I will say, Stephen, literally in the last 90 seconds, I just registered on AirDNA. That's how simple it was. So those of you that are on the call want access to this data, I've dropped the link a few times in the chat. But it took me less than 90 seconds to log in. So I'll flip over to that here in a minute if anyone doesn't have any questions.
Yeah, it's really cool. I mean, it's not like the rentometer that we all knew back in the day, where I don't know what data the rentometer was based on, but tech people have these things. I think they're called APIs, where it's basically a way for one company to interface with another and get data. And AirDNA has some kind of APIs with these companies, so this is just real information, and it makes a lot of sense because this data is there. So if you got a track record of a property, getting this income, and look, it isn't perfect. Full disclosure, I have had properties that make tons of money each year, like way higher than I ever thought. However, they happen to be located in an area that doesn't meet that minimum grade of a B, and that makes it harder for us to do anything on it. So your example right there, you can see B+.
Yeah, I just clicked on the standard thing. I'm on a VPN, so it thinks I'm in Santa Monica. So let's drop a code in here that is a little bit more conducive to. We'll pick something in Colorado Springs here. What's going on? Moving day. No, I'm not in moving day.
I think you have to hit the that little guy there.
Yeah, I don't know what's going on. Here we go.
I find that it's important when using AirDNA that you choose Colorado Springs, but it's also important to put the zip code in.
Okay. How important is the zip code for your team? Are you doing like mileage radius? Or maybe you said it, man, in the slides and I totally missed it, but is the analysis, zip code specific, or is it radius based?
So it's that if you just go off of the city, you may not get an accurate representation, which is why I put the zip code in, because we're really looking for those 5 comps to be
Okay.
within the zip code, to be in close proximity to the subject. And this is kind of too new of a process to really know what wiggle room we have with this vendor. We kind of just go off of what they tell us because there is a lot of risk with this. And so before they get into making exceptions, it's pretty cut and dry. So why don't you try putting in, did you put Colorado Springs, Colorado? I was able to pull it up on my end. Let's see.
Yeah, I did it here. And Summer is messaging me and saying do 80809 because I just did 80909 and it looks like there's some good. So we'll do that. We'll do what Summer would say.
80903. That's downtown. Can you hear me?
Yeah, yeah. $203 active rentals in downtown. Man, that's crazy. That's more than I thought that there'd be. Oh, you know what? I bet it's not giving me an overall grade here because I'm on the freemium version because I haven't paid. I just signed up just to get access. You see all the locks? Subscribe to this region to view, it says. All right. Well, how much does that cost? We're doing this in real time.
I can do it if you want to let me share my screen. I can show you.
Oh, yeah. Go for it, man. Go for it. You have co-hosts, yeah, so I'll let you share. And oh yeah, of course, based on Summer's comment, yeah, she's in Cascade. That's a great place to look for Airbnbs right now in and around the Colorado area for sure. So 80809 or 80903, like Brett said.
You have a Richard Boyle waiting to get in.
Awesome.
Okay, so can you guys see my screen?
Yeah.
So I'm going a little slowly here because I think it's
Hey, I have a question real quick.
Yeah, Keith.
What about like in the city in Colorado Springs, there's, in order to even legally have a short-term rental, you have to get a permit from the city. And the city won't issue you a permit if there's another short-term rental within like 500 feet. So I'm just curious, does that play into this or no? As far as the funding requirements?
as far as like whether the city will allow you to have short-term rental income.
Yeah, does that come into play or not? Because I know a lot of people are doing it under the radar without the permit, and plus there's also workarounds like 30 days plus you can do a longer type scenario. But I'm just curious if from the qualification of the loan where they're taking that income into consideration, do they also take into consideration if the home is available for a permit?
Yeah, so that's to me is one of those like, let's not overthink it kind of moments in that if I can get the report from AirDNA and it provides the information like the investor, one of the rules of the mortgage business is you only submit what you need to in order to get the loan approved. Now, of course, your question's pertaining more to, hey, we don't want something popping up at the 11th hour that could kill the deal, right? Mm-hmm. But I think that the only situation I could envision, or one of the potential situations that I could see as being falling into what you're describing, is if there was something on title that specifically was preventing it from being, or perhaps in the media or something like that. I don't think we're here to dig that deep, but you bring up a really good point, and it could be that at some point that's going to be incorporated into the big picture of how this works. Because out here in California, you have a lot of restrictions in Palm Springs, as an example. It's really stringent out there. I've had people who have sold their properties in Palm Springs because if you get 3 complaints from noise from people using your property as Airbnb, then I think you are banned from doing short-term rentals at all, or even long-term rentals. So it can be very, very stringent for sure. But right now, I don't have anything that would specifically speak to that.
Yeah, so that's good to know. I guess we'll keep everyone abreast if that changes. But for those of you on the call, if you're ever kind of curious as to whether or not a property is eligible for a non-owner occupied permit, I just dropped a link in the chat, but you can email short-term rentals at coloradosprings.gov. If you tell them what the address is of the property in question, that you're curious whether or not it's eligible for a non-owner occupied permit, one that is held to that 200-foot restriction that you were just talking about, Keith, they generally respond within like 24 hours. I email them on a regular basis. They're really great about getting back to everything.
Yeah, they'll get back to you quickly.
Yeah. And just so you guys know, if it's owner occupied, you can have your house on Airbnb for up to 180 days during the year without a permit. Just so you guys are aware about that right now. That's the current rules if it's owner occupied in Colorado Springs without a permit.
I'm having a hard time accessing AirDNA. I don't know what the problem is. Let me just show you guys what a report looks like.
Okay.
So this is here. This is in Henderson, Nevada, and 4-bedroom, 3-bath. I don't think it comes with the truck, but you can see right here, the annual revenue, $84,300. And I got a 60% occupancy. And again, this is falling within the guidelines of the investor of 60%. And here, when we scroll down, you can see these are the comps. So this is the real world information that's being used. You have a comp, doesn't give me the address, but it does tell me it's a similar shape and size. It has 96K in revenue. It's got a 63% occupancy. This one here, you can see 84, 104. So you've got actual information here that's being used to drive that estimate. I think that's how our investor is accomplishing this and allowing it to be used. And then the alternative
opportunity to influence the 5 comps that are done, or is that just like all an internal process for you guys?
It's not. It's just a vendor that's being that's doing. So I don't know of any wiggle room at this point. So it's come up where I've gotten a B- grade. I can actually show you an example. Let me see. I have. Bring up the shared screen.
It's good. These are all non-Colorado, just in case someone owns the property in question on the call.
Probably consider that. So here's this property is a B-. Oops. So this one's a B-. And I don't know enough about the criteria that it has. Maybe it's the rental demand. Maybe it's just because it's really hot. It's Arizona. But this is what we're given, and this is what we have to work with. And in this case, I have a
Go back to the numbers here real quick. I think that looks like the average. Scroll back up to the B-. It was like 68, 51, or 68, 21, 59, 53 plus 17 divided by 5 is 43.6. So it's not the average. It's weighted somehow.
Yeah. It could be within this here. But I mean, we have the occupancy rate of 65. And it could be that maybe you can see in February, you had a high of 701. In August, you got a low of 420. So maybe it's seasonal and that it's come down and people just don't rent as much when it's hot. So it's probably something that we could get the answer to. But
I mean, I would not go to Scottsdale in July either, so I'm not surprised that the market occupancy is low there. So, but okay, so I guess it's probably a good chance if anyone else has any other questions, like come off, we can do a little summary here. So wonderful to know that you guys can do loans for Airbnbs in a potential like manner that it piggybacks off of a DSCR loan, that you guys are actually using AirDNA, a verifiable third-party organization, so that everyone that's hearing this can use that tool to preemptively plan, I guess. 80% of the gross income that it states is what you guys can use as the calculation for the DSCR, calculation itself. And some wonderful, down payment opportunities too, that make it simple for anyone to add one here. So yeah, so if anyone...
just to jump in there, that occurred to me, to going back to one of your questions. So there is one little place where, let's say that you are the listing agent of a property that had at least 12 months of Airbnb activity on it, and you are selling that property for your client. And let's say that the AirDNA reports that we pull have a B minus, or they don't have enough income. You, as the listing agent, if the seller was cooperative, the seller could provide those Airbnb statements to us, the lender, via the loan officer, obviously. And as long as I have statements that show my property address, that show a 12-month period, and show actual income, I can also use that in lieu of the AirDNA report. That makes sense? So like, this is what I would do if it was a refi. If it was a refi and you had a rental property that had Airbnb income, as the borrower, you would just be giving me actual statements that show I make this much. And we could use that. As the seller, it's not impossible. It's very rare that I have a seller that's going to be willing to be providing that documentation. But some sellers are very cooperative and others are not. So if you had someone...
Well, I think that's really interesting because we get a lot of folks that think that because they're operating an Airbnb already, that if they want to sell it and it's already an operating Airbnb, that it has some sort of extra valuation to it. And we try to go down like traditional, like lending rabbit holes, then, we can only use the Schedule E on the borrower's tax, IRS tax, what am I blanking on the word here, but the income tax returns. We have to use Schedule E, which, yeah, I know. Thanks, Brett. Well, that means that you've had to have had it for about a year, right? You'd have to have a tax filing already done so that we could see the rental income on there. And so it's not really a value unless you have the opportunity to work with a group like you guys. So anyways, Brett, I cut you off, man. Were you just correcting me or?
Yeah, I had a couple questions too for Steven. It's in terms of like down payment sourcing, down payment requirement, seasoning, anything like that. Let's say we've got a borrower doing a cash out refinance on their primary occupant. They're pulling cash out of their house to put down on their purchase of an Airbnb using DSCR loan. Is there a requirement in terms of seasoning or anything like that?
Great question. So there's no seasoning requirement. And this is tricky, so let me be careful about how I answer this. On DSCR loans, we do not source funds, right? What we do is we have to document the source of any large deposits into the account. Okay. So there are some restrictions too. One of our main DSCR programs that offers AirDNA as a feature, if you're a first-time investor, they don't allow for gifts. However, at the same time, if the gift is, in this case, the gift I think was 50 or 60 grand, and it was within the limits of what would normally have to be sourced or not sourced. So they deposited the gift funds into the borrower's account. We don't source those funds, so it didn't come up as a question, and we were fine. I will say this, that one of the things with non-QM that is potentially a little more stringent, and which is rare given conforming versus non-QM, is we're very careful about tracking where funds come from at closing. So I have had some very exciting moments with folks that have opened up a HELOC 3 weeks before closing, which then they had to open up a new bank account to get those funds out of the HELOC. And then they had to then wire the funds out of that. We have statements for none of it because nothing's been generated yet because it's so new. So that's a good example of something where if you're just communicative with your loan officer and then with myself as the rep, we always can make a plan beforehand. So that's the only times I've run into any challenges with closing funds.
Got it. And I'm glad you brought up the HELOC idea too, because I think, Ian, one of the things that we want to kind of instill in clients is the idea of if you're going to do this, it's not a weekend decision, right? It's plan your tack and follow your plan. That means if you're going to be drawing out of a HELOC or going to be doing a cash out loan, it's because your long-term goal is to be buying an Airbnb. Start that process now. Talk with the owner now. Get your ducks in a row, so that way when we start the process, it becomes an easier easier path. Nobody wants to do this type of thing where, we're flying by the seat of our pants to get this thing to closing. If we start our plan in advance, in 60 days from now, we start the execution of the plan and start looking for the properties, makes everything easier.
I also have found that the DSCR program in general is a great sort of multi-purpose tool to overcome a lot of challenges that might happen with how borrowers structure their income, how their finances work in general. Because again, we're not getting into all of that. It's a simplified process where we're not looking at how long they've been employed or gaps in employment or multiple sources of income or how they've written off stuff on their tax returns. None of that applies here. It's one step away from a private money loan, and it's assets, purchase contract, property appraisal, and market rent or AirDNA income and title and escrow, and that's kind of it. It's very, very simple, and from there they can close faster than any other product that we have. So it ends up also being kind of a cleanup tool for fallout.
No, that's great. That's great. I think, Brett and I spend a lot of time talking with clients, and they're in and around the idea of like, I'd love to add a rental property to my investments, and great, now's a great time to buy because rates are seemingly high, so you can ask for a lot from like sellers, and you buy the house at the right time and then deal with the refinance, or you can shop around. You've got time to get the final rate that is the best for the long-term like hold, right? But being able to go through that plan, like you said, Brett, is really key. And this is just another arrow in your quiver, right? That you can have that can help a client plan for long-term, right? So really rad there. So, all right. Well, if we don't have any other questions here in the group, I'm checking the comments in the YouTube stream too. I don't see, and we've addressed most of the questions that were in there. So thanks for everyone that came on the call today. The easiest way to get in touch with Steven is actually to go through Brett or I. We'll reach out to everyone that joined the call today. See if you guys have any immediate needs with respect to yourself or all the clients that you guys have that could leverage this product that we just kind of talked about today. Or if you've got clients that are really interested in Airbnb, maybe we can find a time to support your conversation with those clients and through whatever answers that they need for whatever questions they have. So Steven, again, thank you for joining us today. And thank you for everyone else that joined